Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Episode number 1, called Why Business Growth Without Exit Strategy Destroys Enterprise Value. So here's the thing. You can grow revenue and still make your company worth less. And I want you to think about that because sometimes people just believe it's the revenue that's going to drive the multiple, but there's some magic behind the scenes that happens. And what you're going to find out is these companies that are on board for massive exits started planning 10, 5, 3 years in advance and had all the right pieces in place to get the exit that everybody wants to talk about. So what you need to know is growth is not the same thing as value creation. So you could grow a business. You could take it from 2 million to 10 million, but that's not necessarily value creation because growth is filtered through transferability and risk reduction. So what can you transfer? What is the new owner going to receive? What are they getting for the money? And what a lot of people don't understand when it comes to exiting a business is we're talking standard operating procedures, we're talking org charts, we're talking how to make the business work without you. And so when a buyer comes in, an investor comes in, they're looking to say, hey, we're going to invest in this company and we need to take a look at the risk profile. So if we buy and invest in this company today and the owner walks away tomorrow, can this company run? Can it operate? And then the upside is looked at. Then the financials are looked at. So, I mean, there's important parts of the business. Sure, you can look at profita, you can look at EBITDA, you can look at sellers' discretionary earnings, you can look at a lot of stuff. But at the end of the day, what does the business come with? Is it just a name? Is it just the revenue? So what you need to know is bad growth creates fragility, complexity, dependence, volatility, and unclear economics. So somebody comes in and like, we're going to have to put systems and operations in place and bring in managers. And the sad thing is there's companies that sell and they don't get the value. So investors look at this and they're like, this is we're buying under market value because all we have to do is do, probably a year's worth of work will double, triple, quadruple revenue. See, they're used to doing it. So they have all the playbooks. They have all of the people to put in place. They've got all the standard operating procedures. So what might take you 3 or 2 years, they're able to do faster because they have the teams that have implemented this before. So there is revenue growth that increases risk. One big customer, one channel, one rainmaker, one product line. So if you're saying, hey, Scott, I want to sell my business. I'm on that path where I want to go down and I want to sell the business and 80% of the business comes from one client, you're in trouble because this is one of the things that's looked at in due diligence. Almost every single deal that I have looked at, whether mine or somebody else's, one of the first questions is let's talk about client density. Who's your biggest client and how much do they represent in the business? And the general rule that people shoot for is somewhere around 30%. I prefer 20. So if I'm looking at a business to invest in, I want to see that there's no more than 20% density to one client. One channel, like what are we only using Facebook for ads? Are we only using YouTube for ads? Are we only using printed ads, which some people, direct mail is what some people use? Do you only have one salesperson that can make it rain, that can bring in deals? Is there only one product line? Diversity is key when it comes to this. So scale is not the same thing as sprawl. And a lot of companies end up in the world of sprawl. Scale is repeatable. Scale is you could go in on a Monday and be like, okay, this is somewhat boring. We're going to make some magic happen. And the business is going. Sprawl it's chaos. Sprawl is messy expansion and it breaks control. There's no consistency in place. If you're sitting here and you're like, hey, I'm an owner, I'm an operator, I'm a founder, what I'm trying to do for you is illuminate the corners for you to look in the first places so that you can get an exit strategy that's going to get you the most amount of value. And when companies come in to invest, when investors come in to invest, as I shared with you earlier, they're going to discount based upon a cleanup cost. Like, you could look at the company and let's just use really easy numbers. A company made $1 million in profits, whether that's SDE or EBITDA. We'll get to how valuations work in another episode. But if there is a 3 times multiple, and that's for a perfect company, that's for an A+ company, that's what you should be shooting for, like an A+ company, then they would get paid $3 million to purchase that company. Well, if there's sprawl, if there's chaos, if there's not diversification, they're going to go, well, we're going to discount it. We'll give you 70%, which is $2.1 million. Or if there's a lot of problems, then what they're going to do is we'll give you 50 cents on the dollar. And then once again, they'll come in, they'll do all these things that we're talking about. They'll raise the value of the company and they'll double revenue the next year or within the first 18 months. Quick break and message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. What you'll find is founders, the scoreboard that they use is not optimized for what it needs to be. It's optimized for top-line vanity. Meaning that, hey, I got bragging rights. I'm going to sit at the bar and be like, I got a $10 million, $100 million company. I've seen $10 and $100 million companies that have zero profit. I've seen $5 million companies that have massive profit. And so the key here is what is kept after everything is paid off, after everything is done. One of the ways that buyers see the risk and diligence and skepticism that pops up is informal processes, missing reporting. And that's something that should be done daily, weekly, monthly, which leads to weak documentation. So if you're not documenting what is going on inside of your business, and there's no way for you to look at some sort of dashboard, whether it's a bot dashboard, an expensive product, a medium level product, or even just something as easy as Excel or Google Docs, you're really missing out on what could be done. And if you're like, hey, Scott, what should I be looking at? Okay, so we've got sales, we've got marketing, and we've got accounting. Those are like the major 3 things that everybody is like, do you have sales? Yeah. Do you have marketing? Do you have accounting? And in sales, it should be the amount of leads ran, the amount of leads sold, and the revenue. So like with that basic information, and that's pretty standard, you could calculate it a lot. With marketing, it's leads in and it's leads ran or leads talked to. What were you able to keep? What was your closing rate on those leads? And with accounting, it's money in, money out, and accounts receivable. I will share with you across the board, one of the biggest problems that a lot of companies face is the burden of a ton of accounts receivable. And what happens is some companies or some investors or some PE firms, when they buy an organization, will look and say, all right, we're going to buy your company for $3 million. You go after the accounts receivable. Or they give you a staged basis. They may say for 0 to 30 days, we'll give you 80 cents on the dollar. And then for 30 to 60 days, what we'll do is we will pay you 50 cents on the dollar. And then anything above 90 days, we'll pay you 10 cents on the dollar all the way to 120 days out. So if you have a process in place that allows for you to collect money that's owed to you anyway, because you've done the work, it's not going to get discounted later on down the road. And it shows that you have some strength inside of the organization. So there is a growth filter that you can use, and it's a decision rule. And you can ask yourself this, you can ask the team this: does this move improve transferability and reduce perceived risk? And if it doesn't, you can reconfigure what you're doing. If it doesn't, you could switch plans. If it doesn't, you could look for a different strategy. You do want to reframe growth as asset construction. And it's something that you might get a little bit of pushback from inside of the office, inside of the organization, from managers. But you have to build the business like it's an asset someone else can operate, and it's systems and people proof. You're like when you sell a car, what you're doing is you're turning over the keys and you're saying, here's the keys to the car. And if I'm going to use the same analogy, when you sell your business, hopefully what happens is one day you walk in, they walk in, you introduce them to the team. That day you walk out, and the investment company, the investor, the private equity company may say, hey, we're going to retain you for 30, 60, 90 days, 6 months. We'll pay you a salary to stick around. And we want you to be here. We want you to be a part of the company, but you may only be there for like 30 minutes a day. You may only be there available by phone or Zoom if you decide that, hey, I'm gonna move to a tropical location. You'll never see me again. So there is some action framework. It's a simple checklist. 5 growth tests: repeatability, predictability, documented execution, leadership depth, and customer diversity. So I'm going to just go through these again, just so you have them. It's repeatability. Can whatever is being done be repeated? Predictability. Once it is repeated, is it predictable? Do you have documented execution? Can somebody come in and take over that role, that responsibility right off the bat? Is there leadership depth? When the company gets handed off, is somebody there to run it day in and day out? And is there client or customer diversity? Do you only have 1 or 2 people who make up your book of business? Because if you do, you're at risk. So I challenge you today to go through this episode of my podcast, the Sylvan Bell Business Growth and Exit Strategies podcast, and ask yourself these questions for the bullet points that we went through, and take a look and go just create a quick checklist. One of the easiest questions that you can ask yourself is, if I left for a week, would the company run without me? And most people would say yes. Okay, now we're going to double it. If you left for 2 weeks, could the company run without you? Hopefully the answer is yes, right? These are the places where you start to look and say, okay, why would it not run without me? If I'm gone for 2 weeks, what's going to break? And then fix those things, and then double it again. So you're gone for a month. And then you ask yourself, or you ask the team, what do we got to do to fix? What would need to be true in order for me to be gone for a month? And then you fix it. And then we're going to double it again. You're going to be gone for 2 months. What systems, policies, processes need to be in place for me to be gone for 2 months? And then you're going to double it again. And the key for you is, if you could be gone for 3 to 6 months, and when an investor comes in and they say, hey, we're looking to buy your business, and you're like, great, would love for you to go over things. They're going to ask questions, and they may ask, what's the longest vacation that you've taken? Well, I could leave for 6 months at a time. And the company's going to run, and it's going to be profitable. It's probably going to do better without me. That's what an investor is looking for. They want to know that that's transferable value. Mahalo for listening to the Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else, with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.